Hi all, a very good evening to everyone. I'm Akshara Menon from Famous Bazaar, and it's my pleasure to welcome you to today's Friday webinar on the topic Seizing Growth Opportunities with Long-Only Investment Strategy. In this session, we will dive into exciting potential of long-only strategies and how they can help investors to navigate the complexities of the current market while uncovering the attractive growth opportunities. We'll begin by looking at the Indian market, which presents a favorable risk-reward outlook following the corrections we have seen over the last 6 months. While macroeconomic environment may see an improvement, but it's unlikely to experience a massive shifts. This may shock the stock pricing and sector churn even more critical by driving the alpha generation going forward. Furthermore, we are on the cusp of the significant economic transition driven by the new technologies and geopolitical shifts. These transitions will unlock some of the most compelling growth ideas for the future, which will be the key identifying the next big investment opportunities. Now, let's talk about Amberson Capital, the firm that's leading the discussion today. Amberson has been backed by a highly rated team by equity research analysts with a combined experience of over 40 years. Since its inception in September 2017, the firm has consistently ranked the top quartile among the peers as the CRISIL study showing its proven track record. Amberson's approach is built on the collaboration, open mindedness, and commitment in uncovering the unlimited potential in the investment landscape. Now, let me introduce the esteemed speaker of today's session, Mrs. Sanjaya Satapathy, with over 16 years of experience in equity research across multiple sectors. Our speaker is recognized as the best mid-cap analyst and the best stock picker by StarMine. Before joining Amberson, he served as a senior analyst at Bank of America, Merrill Lynch from 2006 to 2016. And I have an insightful conversation with the speaker and how long-only strategies can truly position investors to realize opportunities ahead. Over to you, sir.
Thank you, Akshara. Thanks for the lovely introduction. As Akshara has already mentioned, we are meeting at a time when market has corrected quite a lot. And the key question that is there in everybody's mind as to whether this is a good level to invest in or there will be further pullback and what kind of sector or stocks will do well going forward. Risk reward per se is favorable now. So though we cannot really call a bottom to the market at any point of time or call out the peak. Yeah, so if we look at it from a risk reward perspective, it looks better. And why? That is because valuation, which was a huge concern throughout last year almost, that has corrected quite a lot. As such, most of the key indices have fallen almost 15% from the top, and more than 50-60% of top 500 companies have fallen more than 30-40%. And if I just look at the top 500 companies, now almost 1/3 of them are trading below 25 times price to earnings, and another 40% are trading at around 25 to 50, the average being about something like 35 PE, which is much more reasonable than what was earlier. And at the same time, of course, the earnings growth, which used to be much stronger earlier, are no longer the case, but still around 12% kind of profit growth for the large cap index and around 18% earnings growth for the mid cap index is something which we are continuing to expect over next couple of years. And this is where I will just go back to highlight that one has to keep the long term in mind while investing, because these numbers like 12%, 18% growth, they don't really change dramatically overnight. Whereas the sentiment about stock market direction can make you overlook the long-term trajectory and end up making mistake and not take advantage of corrections. So we have to keep these things in mind, and these things clearly tells us that risk reward are kind of favorable. Though though I will just say that we at Ampersand are kind of growth investor, and we typically prefer companies which are showing at least 25% kind of growth. And in subsequent slides, I'll talk about which kind of areas where we are kind of seeing that kind of growth. But suffice to say that we are seeing this as a bit of a favorable risk reward right now. Our preferred themes where we think that the growth will still be fairly strong are wherever the technology disruptions are happening, starting from artificial intelligence to in the pharma side, the kind of research, etc., which are happening, and electronics, wherever there are a lot of new things are going on at this point of time. And lifestyle change, where which always is a structural opportunity, that is premiumization. That's something like we have seen in case of India. People are shifting to SUVs, people are shifting to premium motorcycles, people are going for travel and luxury hotels in a big way. So that premiumization will continue to be fairly strong. And the energy transition is something which will be the other thing where there will be strong growth. But while we are talking about all these three themes, we have to keep in mind that we have to invest in the right stocks, because not all companies have the ability to execute properly and deliver healthy return on capital employed. And we as investor, while we should talk about themes, we should be very, very focused on the numbers part. So it is not just the narrative, but a narrative plus number, which will help us identify the right stocks. And that is where we kind of pride ourselves, that it is not just, obviously, we are very, very focused on right stock most of the time. So now to talk about a bit more about the macro scenario, which is worth highlighting, because we are heading into budget as such, and it is worth pointing it out. One of the reasons why this pullback has happened in stock market, that is, as you can see, that GDP growth rate, which was something like 8.2% last year, has come up to 6.2%. And even Reserve Bank of India was expecting something like 7% plus GDP growth in current financial year. And that kind of a deterioration in growth rate and the subsequent year growth expectation has been the primary reason why the market has corrected. But having said that, whichever way you look at it, we have kind of hit the bottom in terms of the growth rate. On a quarterly basis, September quarter was the lowest, that is 5.4%. And from there, we are likely to see recovery from 5.4 to 6.2 to 6.5. And if you look at the previous such instance of correction, that is in Q3 of FY23, which is where our GDP growth rate bottomed out around 4.3%. Those are also the kind of period when the market also started bottoming. And while the amount of recovery is something which people are doubting at this point of time, there's some people are talking about U-shaped recovery. But whichever way we look at it, whenever there is this kind of a bottoming of macro growth rate, then subsequent sentiment kind of starts to improve. The market tends to kind of bottom out. So that's something which is very important to keep in mind when we are forming a view of the market. And if you look at some of the primary reason why our economy, whichever we look at it, has stayed at around 6% plus GDP growth rate, which is a fairly resilient number, which is not a totally bad number to begin with. And that is because our banking system has been kind of fairly strong in throughout all this. If you look at the NPAs, etc., are at a fairly low level. Banking credit costs are at a fairly level. So the banking group system robustness will make sure that we are not really getting into some kind of a financial crisis. And historically, in the absence of financial crisis has always meant that the phase of bear market are not deep and protracted. And that's something also is something which continues to be favorable. Of course, things can be plus minus 10-15%. But overall, if we are to kind of look at the fact that financial system is fairly resilient, and when in valuation terms we are seeing improvement in risk reward, probably we will start seeing improvement. Now, coming to at ampersand, what we are doing is that it, we are continuing to be focused on growth opportunities. And our portfolio companies, even in quarter two, when there was hardly any earnings growth, our portfolio companies delivered over 20% earnings growth. And we are continuing to expect our portfolio companies to deliver that kind of numbers. Because as I said, that while overall market will have its factors pushing and pulling the growth rate, but there will be enough growth opportunity because it is such a large economy and it is still growing at 6% rate. And global economy, as you know, like it is like be it USA or some of these large economies, they are continuing to do reasonably well, if not great. And in fact, the stock market fall that we have seen, it has been kind of primarily isolated within to India. Most other markets are continuing to head new highs as we are speaking. So if India manages to resolve its issues and manages to recover the GDP the way I just presented, and our portfolio company deliver the kind of numbers that we are talking about, then probably we'll again go back to delivering good return to our investors. There again, we are kind of fairly diversified. That is what is kind of taking care of the risk part of it, and some of our stocks continuing to be the leader in their respective space. And if I just kind of look at just kind of summarize it, that we have been top quartile. We have been fairly consistent in terms of our performance historically, and this has been our kind of performance. Though now we have started on a wrong foot, so to say, the calendar year 2025, but considering that we are probably at a bottom and things may look up soon with a couple of things like interest rate cut and the budget fears kind of getting addressed, wherein some people feel that again there will be some kind of a change in tax codes. With all those things behind us and our and the benefit of a great monsoon that was there in calendar 24, and the recovery in rural side also becoming visible, we will possibly start seeing the sanity returning and market starting to recover. Akshara, probably we can start Q&A.
Yes, sir. Absolutely. So it was very short and more about the PPI, more about the product PPT. So before we could dive in, and let me ask one market question, because today market was not as expected. It was much lower, and I just want to ask the previous webinar when we had with Arun sir, he was anticipating for Trump to take the position as a US president. Now, Trump has already been appointed, and you could see the FII selling on the other side as well. So, what is your overall health outlook on the market? How do you feel?
Yeah, yes, both the things have happened to coming to Mr. Trump. So if you look at it, the biggest fear from Trump's presidency was that they will increase tariff quite a lot, right? And the first casualty of his tariff announcement was supposed to be China. Okay, but nothing of that sort has happened. In fact, the China market has done pretty well today as well as this week. That's one thing which is very important to highlight. But at the same time, some of the policies which he has spelled out, which are very clear that you cannot really have a differential tariff policy with USA. So that means that India will have to give some kind of concession in some areas. Uh, uh, and the second thing that we have to also highlight here is that whichever we will look at it, Trump will be positive for their market.
Mm.
Okay, because they're talking about tax cuts, they're talking about big investments, and at the same time, he's also talking about their interest rate falling, and Trump is also talking about that US dollar not strengthening much from here. So from our market, as long as we are not really seeing a currency crisis and we are not really seeing a interest rate crisis, like rate interest rate going up a lot, then we should be okay. Till now, these FIIs have been pulling out money primarily because the dollar was strengthening a lot, and that had triggered a risk of in a big way. Typically FIIs are taking such macro decision to take money from one side to the other side. And today FIIs are hugely underweight in India, and
Mm.
so it all goes back to probably where the currency will stabilize. So we are seeing some sign of stability. For instance, today rupee was again slightly stronger, but that did not really help the market. Market is probably overreacting to whatever the sentiment getting worse. But this is where I would rather say that considering that Trump is not going to be bad for the market,
Okay.
and and the fact that he doesn't want interest rate to go up, and he doesn't want currency to be too strong. We should take solace from that aspect, and we should refocus on businesses and companies, because the macro risk which was supposed to kind of pan out has already happened.
Yes, okay. And adding one more to your point is that rupee has not fallen much as other currencies actually. Rupee has still not fallen very badly.
That is true. And one more point which is very important to highlight here is that most other, let's say, for example, US government bond yield, the 10-year bond yield, has gone up more than 100 basis points since Trump got elected as president. Okay, but throughout this period, India's bond yield has not moved at all. It has remained stagnant. So
Yeah.
it has been very stable, which is a very big data point. And the second data point that has happened as far as India is concerned, that during this period, our food inflation has come off, which is why our inflation has started falling, which again, with kind of weather supporting, we will possibly continue to see that food inflation kind of coming under control, which is why you will probably get a rate cut, which is very important at this point of time to revive the sentiment in early February.
True, sir. And one question on the quarter earnings. Now that we have got ITs and banks giving up their quarter results, so I just want to know where was it to your part, or do you feel that it has given bit negative, or do you feel things are going bit better than quarter two results? What is your feeling?
Compared to quarter two result, IT companies have done better in quarter three, and their order win, deal win, etc., have been much better. So that is why some of them have given a much better outlook for quarter four. And in fact, the reaction to results announcement has been more or less positive. Of course, it is mixed, so to say. Basically, Infosys and ACL Tech fell a lot after the result, while everybody else almost have gone up after the result.
True, sir.
In terms of banks, let's say Kotak Bank reported a great result, and the stock went up a lot after that, while others are kind of drifting there. But result per se were not below expectation, and in fact, the biggest concern for banks was that credit cost will go up a lot, which has not happened. Despite the fact that the credit growth has slowed down quite considerably, rather alarmingly. Normally, whenever credit growth becomes so low, typically credit cost starts to go up, and that has not happened. So to that extent, bank results are also pretty okay. So banks and autos have done, banks and IT have done okay. It is the consumer space where the disappointment is still there. and that is something which is continuing like quarter two. In commodities space, there is mixed thing. For example, some of the cement companies have reported better number than that was feared. Like Ultratech yesterday reported result, and Dalmia Bharat reported result. Though they were declined, and the earnings were down year on year, but they were better than expectations, so the stocks went up. Reliance Industries reported a decent set of number compared to a sharp decline in quarter two. The quarter three was better. So overall, it is like still a mixed picture. If you look at quarterly results, like consumer-facing companies are still seeing some kind of problem. But within that, some of the rural-facing companies are showing some amount of recovery. But then, what is happening in the consumer space is that there are some that the rural, while it is showing better numbers, the urban side is showing a little weaker numbers. I'll just give you, for example, this Zomato, which reported its result. It showed only 2% quarter on quarter growth in their food delivery side. Okay, which is a which and they attributed it to sharp slowdown in demand for consumers from middle of November. Basically, it was doing okay in the festival season, and after the festival season got over, the slowdown again started. So that is something which is little all over the place. Commodities is continues to be mixed picture. IT is okay, pharma is still okay, and the banks are not too bad.
Okay, sir. And to talk on more about your product, the Growth Opportunities Fund, industrials as a sector has given a quite a good position in your portfolio, but it has underperformed since the December, and still there's as such an industry is experiencing a bit of volatility. So how are you accessing this situation?
Yes, you are right. And in fact, even in our previous conversation, also we had said that there are within industrial, we have tried to exit the deep cyclical ones. So, for example, there are some railway stocks which had benefited a lot. I mean, we are probably proud to announce that we could manage to exit at the best possible price. We have not done the same for almost all the stocks that we would have liked to. But in within industrial, there are two type of industrials. There are two, three types. Basically, there are some which are very deep cyclicals, like let's say railway or wind energy or something like that, which are deep cyclical. Like they do well in for 2 3 years or 3 4 years and do badly for 4 5 years. Then there are short cyclicals. Let's say, for example, those which are providing, let's say, these companies like Polycab kind of company, which are providing wires and cables. And then there are companies like Cummins, which are providing those engines to data centers and such things. They rarely they rarely go through deep cycles. So we are positioned in those short cyclicals one, and also we are positioned in those companies which are not really influenced by government's decision to do infrastructure or deep cyclicals within private sector like steel industry or let's say some chemical industry. We are not really positioned there. Where we are positioned are one is that relatively less cyclical ones, and the one which are positioned in certain things. For instance, let's say Cummins. It is likely to benefit from the fact that there will be these data centers, and also the fact that there are emission changes, that are regulation changes which are happened in the gensets and the industrial side, and that gives them a technology edge in terms of competition because they are globally capable, and their competition in India may not be that capable to meet those new emission changes. So that way that they will benefit. So we are taking a very bottom-up approach in industrials, unlike let's say what we had done earlier. So to that extent, we have tried to either trim some of these names or shift to some of those names which are not that cyclical. And for example, if you look at companies like Blue Star, or companies like Keynes or PG Electroplast, which are into manufacturing of, let's say, air conditioners or such things, they are also classified as industrials, but they're not necessarily the kind of like typical names that you talk about, like Hindustan Aeronautics or BHEL or L&T. So we are trying to position there. There is a third type of industrial which we are not getting into, because, for example, there are these consumables like bearing companies. There are these abrasives, those kind of names, which don't really see much of a cycle. But we are not really seeing any kind of valuation comfort there, though. But that is something which one can probably think of at the right point of time. The net what I'm trying to say is that we sense a change in the way the capex cycle was panning out, and which is why we have made some adjustments. We are staying in those which are bottom up stories and which are more of have their own things which are going, and less cyclical. The deep cyclical ones which are dependent on government policies, or they're dependent on government infrastructure policy or government's policy on, let's say, some of these steel and those sectors. That is something which we are staying away of.
Got it. Now that we are talking more on sectors, I'll take one question from the participant, Ananda. So you discussed few sectors, but how do you see CDMO as we are getting more good contracts to manufacture pharma and APIs? Secondly, PM Modi said EV is going to replace 30% of the vehicles in the country by 2030. How do you see these two sectors? Your outlook on these two sectors?
See, the CDMO is a great theme, and it is probably going to continue. But to begin with, the scale of opportunity is far bigger than what our company size are. Okay, I really don't. I just want to give some explanation about why we chose CDMO over generics. That is, we chose it because in generic pharma, the expectation of government as well as the customer is that every odd month or year, the price of the product will go down. Okay, and that is something which is a very tricky game, in the sense that you have to constantly come up with a new product. Otherwise, you will end up selling a product which was cheaper every 6 months or year. So that is why you have to continuously introduce new product, and then the getting approval for it, and whether it is something which will be which will come to you in time, whether you will get it or somebody else will get it, and then the amount of R&D you have to do. It is a far more complex investment decisions. Whereas in case of CDMO, a lot of these players, they are helping people's research activity, whether it is a new drug molecule company, or even somebody who is trying to get a new first to file for a generic drug. But they are essentially helping them in the research activities, or are in an activity where there is no pricing erosion impact on CDMO players. Okay, which is a big thing, which is favorable for CDMO. At the same time, the need to bring down research cost is immense. Because let's say, for example, even generic pharma companies spend 10%, 8% of their revenue on an overall basis, and for the US, some 50% plus as research and development expenditure. Just a company, like say, for example, a company in India, top 5 companies, they are spending 20,000 crore on research annually, which looks big, but a single company like Eli Lilly, they are probably spending $10 billion on R&D alone. So it is a huge market, and India's market share is very low there. Unlike generics, for example, in generic tablets, India market share is 70% in USA. Okay, 70% plus. So how much market share gain can happen? And as you know, in ampersand, we always look at companies which are going to gain market share and margin.
Yeah.
And in case of CDMO, our market share is very low. And that is and the pricing is, which is the reason why we are choosing it. Now your question as to whether they're getting a lot of contracts. See here, that question can be answered two way. One is that does microeconomics play a role? The answer is yes, because the biotechnology funding needs a lot of the cheap capital. So to that extent, that part is still little cautious. But at the same time, the worst part of that rate cycle is kind of behind us as far as biotechnology funding is concerned. But the second aspect is that of whether there are more research which are going to happen, whether there are a lot of opportunities. So that is where the answer is big yes. Why? That is because let's say the technologies like AI are helping develop molecules a lot faster. Okay, but then just developing molecule on in the computer is not anything and not everything. You have to go and test it with patients. You have to go and study the output. So those are the things which the CDMO guys do. So which is because of which you will continue to see this segment doing well.
Okay.
But here again, it will be company specific. Not every company will be able to do it. Not every company has the capability to do it, and the way it will play out will be very different. And it is not going to be a very linear business, because you may get a big product opportunity right now. So that is why it is, even if we will be very excited about some of these names, we may not be able to like allocate like 8-10% to each of these companies, or even to that sector, because their earnings will be very volatile.
Okay. So, a few answers ago, you were saying that, AMS is more of a bottom-up approach. Correct. So, when you're having this bottom-up approach, do you think the broader macros is going to affect so much when you're going to choose this bottom-up approach, sir?
See, it has, see, whether we like it or not, it affects, right? Because, see, for example, there is this company we own which has gone down a lot, like Polycab. They continue to deliver. Their results was very strong. Most of the brokers, they upgraded their estimates even after that. But still, the stock has gone down. It can be for many reasons. It can be for one of the reason is that some of these investors, they are seeing pain elsewhere, so they have to exit something. And a lot of these borrowing, people invest in the market by taking borrowing and margin funding. So whenever the market kind of starts to go down, there can be a lot of technical factor. But those factors will be very short term. So that is where your question, basically, these technical factors like macro, some of these things can affect bottom-up stock picking on a short-term basis, which is, but long-term investors like us who know the story and have the conviction will be able to hold on despite this volatility, which is why they will be eventually get rewarded. So that is where this whole bottom-up stock picking has to be understood. That it is just because you have figured out this stock and the earnings, it doesn't mean that the stock will have a linear movement. It will be impacted by market corrections, pullback, etc. But when we are talking about bottom-up stock picking, we understand the story, we understand the company. That is why we will be able to have conviction and holding power, and that particular strategy will play out over long term, and that is how we will generate return. But short term, anything can happen.
Yes, sir. So let me go to the stock thing. Now, of course, when you spoke about Zomato, and it's your quarter-on-quarter growth. The major force behind Zomato's recent growth was significantly driven by the Blinkit part of it, which is a quick commerce. And we have other big players, not only Zomato, we have other big players like even Amazon, and we have Flipkart. These also are getting into quick commerce recently. So there is a hit on the business side of the model. So how do you see that?
See, this is something which in our presentation also we have mentioned that many times, that every business goes through a cycle, and that cycle, because of the investment at some phase the companies will get into negative cash flow because of the investments that they're doing, and that is the time when the stocks do badly. And once the investment is over and the return on investment starts to kick in and the free cash flow become positive, the stocks tends to do well. And so right now, what you are saying is that is this land grab which is going on. The better way to put it is not that Amazon is getting in or Flipkart is getting in or XYZ is getting in. It is the land grab which is getting in. Okay, and the which, and it is like the first mover kind of a thing. So the Zomato, basically on Blinkit side, they had announced that they will set up 1,000, let's say, dark stores by let's say somewhere around 25 end. They are doing it 1 year before that. They had planned to do 2,000. They are doing it some one and a half year before that. So what everybody is trying to move fast. Okay, so once you have that 2,000 dark store, because there are so many cities and there are so many places you can deliver to.
Yeah.
Right. So if you have managed to put those many stores before, let us say, Amazon thinks of it, then even if you have so much of money power with you, you still cannot do it. Right. See, for example, this Delhi food delivery, it was open to everybody. Uber Eats tried it, probably Zomato and many others tried. But at some point of time, it winner takes it all, kicks in. That is, you have established the platform, which in case of Blinkit, it will be those 2,000, which is the reason why the company also has said that they will see 2 quarters of negative cash flow. And from there, the turn will happen. Now, as an investor, it is our choice whether to stay invested through those negative free cash flow or try to time it that okay, those cash flow phase is over now, the recovery is starting, and let us start investing. So if you look at Zomato stock price movement over last 2 years, the first time when it got listed, it started tanking. Okay, and then the food delivery business stabilized between
Yeah.
them and Swiggy, and margin started improving, and the stock started doing very well. The stock went up almost 5-6 times from the bottom. Now this investment phase of Blinkit has started, and the stock has started to go down. So once this kind of investment kind of peaks out and the land grab kind of settles down and we get to kind of see a stable scenario, okay, this guy is happy with X% market share, that guy is happy with Y% market share, and all of them will probably start growing together. Basically, whosoever survives. So eventually, it will be 2-3 guys will survive. It is not going to be like some 10 companies which will kind of a business, right? And then again, the stock will start to perform. So what we have seen is that both these 2-3 companies are great at execution, and they are anticipating consumer much better, which is the reason why you are not seeing, for example, by the time they are already having 1,000, Amazon is talking about getting in.
Yeah.
So they are really late entrant. That is, the speed is of essence. And if you are not doing it, then even if you are a great name, for example, why Amazon? There are many people like Tata's are there, Reliance is there, anybody can get in. But they could have gotten into food delivery, but they did not do that. The same thing will happen here. So we feel that it is a matter of 1 or 2 quarters more, because the speed at which these guys have rolled out their dark stores is like amazing. Okay, and because of that speed, you will see the competition settling down in 1-2 quarter time, not too much. If they would have been like adding a few dark stores every quarter because they are very concerned about the cash flow, then this competitive intensity, the call on when it will settle down would have taken probably a long time, like 1-2 years. But because this time they are really moving very fast, and and each of them what have raised money, let us say, and Zomato itself is sitting on 20,000 crore cash. And in the quarter of December, that Blinkit business, that loss was probably the peak loss, because the number of dark stores they had added was probably the peak. Even if they're accelerating it, they're not going to add more number of stores than what they had done in December quarter. So these are the things that we are looking at, and in fact, this will teach us a classic way to look at these platform companies and classic way to see that how the cycle plays out in terms of investment and consequent return.
Okay, that was very elaborate answer and also different perspective from the normal one, sir. Thank you for that. And the one more question I'll take it from our audience is that when you see overvaluation companies, would you continue holding them or start selling the process? How would you balance between today's overvaluation of the company and tomorrow's relatively high growth that may come?
See, it has been very tricky subject. Okay. See, for instance, one of our portfolio companies that is Trent, we have been holding it for 5 years. And at one point of time, it was almost 7-8% of our portfolio. Okay. And in fact, we had sold it. We sold 30-40% of our portfolio at a price of around something like 6,500. The stock after that had gone up all the way to 8,000.
Yes.
Okay, but we always were convinced about the story, so we never wanted to make it zero. Okay, we always wanted to hold something like 4% in our portfolio. So that's why we did not sell. The stock is now at something like 5,500. Okay, now we may look like a fool in hindsight, right? That we should have sold at 8,000. It looked like a great. But then when we are looking at one is India and then the stocks. What India keeps talking, like our Prime Minister keep highlighting that we are the fastest growing economy. Even though we have slowed down, it is still 6%, right? Which is not really a bad absolute number, so to say. And similarly, how many companies are growing at 40-50% and have 30-40% kind of ROC, ROE that they are not really raising equity to fund that growth. So Trend is one such company. So then so that is where while I agree that one should be looking at euphoria and pessimism to manage the portfolio weight, but it can help or make you keep your sanity in the short term. But over long term, if it is a great growth company, you will not really miss out by not timing it right. On Trend, for instance, it has all even before COVID, it had already traded at 100 plus PE. Okay, it has never like it has rarely, probably today it is trading at its lowest ever price to earnings. And if our numbers are right and that company delivers, then it is probably trading at something like 70 PE on FY27 or thereabout, 70 or 60 PE, which is probably is something which is way below where it has ever traded. And particularly when this company earlier, it was only one trick pony, so to say. Let us say it is only, there was a time when it was only west side, that is that upper premium fashion. Then it went to fast fashion. Today it is getting into the Star Bazaar, which is the food segment, and it is also getting into beauty segment and lab grown. So when it has expanded its number of verticals on which it will operate and the growth outlook remains constant, we feel that only thing that you can do is adjust the weight. But if you hold on to it, these are going to be wealth creators, not companies which are growing at, let's say, 5-6%, even though their valuation has corrected. For instance, a company like Asian Paints and HUL, their valuations have corrected to way low level, right, compared to where they had traded. But they are showing 2% earnings growth maximum. And there is no real clarity that they will go back from 2% to something like 10% also. At best, they may go to from 2% to 4-5%. There will be only handful of companies or sectors which will grow at more than 25%. And it is, and that valuation question, it is not just us. For example, in company USA, the companies like Nvidia, which have become multi-trillion-dollar companies, multi-trillion-dollar company rather, then the valuation, just look at them. if you instead of investing in them, you would have invested in something which are like value, like Qualcomm, then you would have not gone nowhere. So that is the reason why we emphasize growth a lot more than valuation per se. But we will have to do those risk reward management and weight, etc. But even then, also we will feel sorry from time to time. But then that is part of investing thing.
Got it, sir. We'll talk on the weightage part of it. And with the current market scenario, the weightage is more towards a large cap when compared to smaller mid cap. So how was Amberson has positioned its growth opportunity scheme towards this small, mid, and large?
See, we generally we try to be one third, one third, one third.
Okay.
Okay, but that is the median average. So whenever the market are euphoric, let us say we will increase our weight of large cap towards something like 35% or 40%. But but generally we are today looking at both combination of valuation and combination of where the markets are. We are probably 25 odd percent, 25 to 30% large cap, and something like 40 to 45% mid cap, and 35 odd percent large. But having said that, companies which are less than 10,000 crore market cap will rarely be more than 6 odd percent of our portfolio. Okay, and the very last thing that I must mention here is that we are just looking at the index and giving a comment that large caps are doing better. But if you look at it within large cap also, what is happening is that the stocks which are like cash-like stocks, which are not going to go anywhere, those are the things stocks which have given resilience to the market. For example, HDFC Bank has not fallen
Yeah.
because it has not gone up. It will not fall, it will not go up also. They're like quasi cash, which is giving. But is that the right thing to do or to sit in the cash? So what we have done is that we have taken up our cash level to almost like 15%, which we rarely used to take it to more than 3-4% earlier times. So what the way we are thinking is that now that the pace of market fall, whatever it is, there is nothing like basically to hide in some stocks. Either you stay in cash or buy the stock which will do really well. Don't really now that the market has fallen, don't really settle for something which will go up some 8% or 10% over next 1 year.
Okay. So now that you said you're sitting in cash of almost 15%, and the next event which is most anticipated is budget. So you're planning to deploy this 15% after the budget.
See, I don't really. It has always been very difficult to react to budget. Okay, every time budget comes, everybody says that it is a non-event, and they announce something. Then you go and read the fine print, and by the time market reacts certain way and the other way. So it is not as if like we are waiting exactly for that. And just the day, the week after the budget, there will be this RBI policy. Okay,
Yes.
so we will constantly wait for that. So what we are really trying to do here is that as you have said that there are certain sectors which are going out of favor. There are certain companies which are getting into some kind of trouble. Let's say, for example, Zomato is seeing this kind of issue, or some of the power companies are facing certain issues. So this cash are being raised to change from this to something else which we think that will do better. Let us say, for example, just to kind of tell you, let's say, for example, IT probably could do better, or a pharma could do better, or some XYZs could do better. So we will rather done this to shift it to those names which we have identified. Budget is not really something which is exactly playing in our mind, because last thing that I will understand or I will think that will be great is budget. Because standard thing happens there, budget happens, and all the big people will come on TV and they say that it is a great budget. Then
Yes.
then something else, and then the fiscal space is not much also for the government to do some to do give something. And the finance minister out of turn had high capital gain tax in a budget which she could have easily waited till the budget
Budget.
of
Yeah.
February, which she did not do. So that is why it is an event. A lot of people will talk about it, but we will be very hesitant to make any decision because of budget.
Okay. Got it. And coming back to the last question for the day is that, regarding the churn in the portfolio. Being it a growth portfolio, how long you expect or, how do you estimate a stock to stay into your portfolio? Is it 3, 5 years? Do you time it? I want to-
See, while we are talking about growth, we are not really into one type of growth story. Basically, one type of growth story is structural growth stories, which like Trend, etc. They are structural growth story. But as you found out, like even Zomato is also a structural growth story. But they also go through their investment phases. But then typically we will like to stay invested in structural growth stories forever, though we will change the weight depending on the valuation.
Okay.
Uh, then there are these cyclicals. So you have to basically, for example, an automobile company or like say those engineering goods company that typically cyclicals. So that is where we will have to. But then as our philosophy is that we should never invest in companies which we cannot hold for 1.5 to 2 year at least. But what we have also seen that in our country, every 2 year there is a bear market. Okay, 2 year of bull market, then 1 year of bear market. Like that is what is going on at least since 2020, and that's something which will probably continue going forward as well. But we have to live within those parameters, and our churn rate will depend on how suddenly the market is becoming euphoric. For example, there are periods like 2018, 2019, we had hardly any churn. Okay. Then came 2020 where you had to make a lot of changes. Then there was hardly any churn in, let's say, in 21. Then a huge churn happened in 22 to so that the whole average churn for the period of 7 odd years will be about something like 25%. There will be years when the churn rate will spike, and there will be years when it will be far less. But it will of course depend on valuation, market cycle, business cycles.
Got it.
So
Thank you.
again, that is what will be the key thing about AIF versus, let's say, mutual fund, etc. That is because they are managing themselves in a very standard manner, whereas we have those flexibility about deciding market cap, deciding allocation, and deciding churn rates, and those complexities are the one which will help us deliver better return compared to, let us say, mutual fund which have this tax advantage over us, but we have to do something different, right?
Yeah, that's true, sir. So with that, we have come to the end of the session, and there are a few more questions which were not taken, and that can be taken offline because that is more into the product and more to the NAV and performance can be taken offline as well. I request, those questions I'll be mailing it to you, sir. I request you to answer them and give it back to us. Well, thank you, and it was a very very detailed presentation, also a very interactive session, I would say, with more on markets and earnings and more on this sector allocation, everything. Thank you for this. Thank you for taking
Thank
time.
you so much.